Despite growing demand, Golden Agri Resources, the second largest producer of palm oil in the world, has been delivering results below expectations. The company is facing three challenges. First, increasing costs. Second, palm oil price decrease. Third, consumer sustainability concerns. These challenges, along with the palm oil industry and Golden Agri Resources company strategy, will be analyzed on the following video. Vegetable oil is a key resource to feed the world growing population. These oils, also called edible, can be extracted from different sources, such as soybean, palm, rapeseed, among others.
What is so special about this palm tree? Take a closer look and you can see. It's a palm oil tree. Its fruits are used to make palm oil. Palm oil? Sounds exotic. Actually, we use palm oil every day. It's one of the ingredients in margarine, chocolate, washing powder, lipsticks, cream, shampoo, pastries, baby food, candies, deodorant. In Africa and Asia, palm oil is used for cooking. We consume quite a lot of palm oil. 12 million hectares of land are already covered with palm oil plantations, mainly in Malaysia and Indonesia.
Indonesia is the world's biggest producer of palm oil. It's also losing its forests at an alarming rate.
In 1985, Rio in Sumatra was covered by a natural forest. The natural forest was the home for wild elephants and wild tigers. But since the industry came into the province, that then start the deforestation.
Palm oil can be produced sustainably without clearing valuable forests and habitats.
So, where are the profits going in the industry? The threat of new entrants is low. New palm oil players are emerging in countries such as Brazil, Benin, and Kenya. However, in order to be competitive, large tracts of land and advanced technology are required. Moreover, it takes 3 years for palm oil to bear fruit. Malaysia and Indonesia are likely to maintain their dominance. The threat of substitutes is also low. Although the price of crude palm oil is linked to the price of other edible oils, such as soybean, rapeseed, and sunflower, palm oil is used in more than 50% of all consumer goods. Palm oil is 4.5 times more productive per hectare, cheaper to produce, and less vulnerable to weather. A palm oil tree also has a productive lifespan of 40 years. Global demand for palm oil is expected to double by 2020. Most major producers of palm oil produce their own seeds. The key suppliers of this industry are therefore the workers and small-scale farmers that big producers are required to purchase from by law. Because of the critical importance of the palm oil industry to the economies of Indonesia and Malaysia, the industry has more access to government and greater bargaining power relative to workers who are by and large unorganized. The power of suppliers is therefore low. On the other hand, the palm oil industry is entirely driven by buyers. 75% of palm oil production is used in food products. The industry is therefore very dependent on consumer demand. Although the overall threat of substitutes is low, if consumers in India decided to switch to sunflower cooking oil, this would significantly impact the industry. The second set of buyers are the commodity traders. The price of crude palm oil futures determines the profitability of palm oil producers. Industry information is not always available, and the process of setting crude palm oil prices is not transparent, giving commodity traders a great deal of power. Finally, the biggest direct purchasers of palm oil are FMCG companies. Unilever alone purchases 3% of total palm oil global production. The immense power of buyers is best demonstrated by the recent introduction of sustainability standards. Consumer awareness campaigns have resulted in the big FMCG companies committing to only source palm oil from sustainable producers by 2015, and working together in the Roundtable on Sustainable Palm Oil to set the environmental standards for the industry. Finally, because palm oil is a commodity, rivalry takes place on the national level. Indonesia and Malaysia compete for export volumes via subsidies. Similarly, India and China control the level of imports via tariffs. The industry is highly sensitive to trade regulations, and rivalry among exporters and between exporters and importers is high. Profits in the industry are therefore flowing to the bottom.
Let's now see what Golden Agri Resources, or GAR as we call it, is all about. GAR was founded in 1996 and was listed on the Singapore Stock Exchange in 1999. The market cap of the company was $7.5 billion as of 22nd March 2013. 49.95% of the equity is owned by the Widjaja family based in Indonesia, which also owns the Simar Mas Group, which has investments in paper, financial services and real estate. Now getting into the operations of the company, we see that the company has operations in Indonesia and China. The company has tried to diversify by starting operations in China. However, the major share of revenues come from Indonesia. The company is vertically integrated in its operations in Indonesia. They produce seeds and the saplings are grown in their own nurseries to maintain quality. The key competency of GAR is their widespread palm plantations. They have planted area of almost 500,000 hectares. Crude palm oil extraction is done in their own mills. They further refine the crude oil into processed products like cooking oil and margarine at their refineries. The byproducts of the fruit bunches, the palm kernels, are crushed to produce palm kernel oil and are also used for the production of oleochemicals. The processed products produced are marketed and sold by the company. Branded oils like Filma and Kunci Mas are very popular in Indonesia. They have in-house R&D facilities to support all the functions to improve productivity and quality. GAR is equipped with advanced IT systems for real-time monitoring and controlling of all operations. They use advanced technology like aerial manuring for increasing efficiency. So we see that the vertical integration of the company has helped it lower transaction costs, synchronize supply and demand along the value chain, control quality, adopt technology quickly for productivity gains, and gives it the ability to differentiate its products. Moving to the operations in China, they own a deep-sea port and storage facility to import soybeans. They crush and refine soybean at their refineries. They produce not just soybean oil, but also soybean-based food products like noodles.
What are the financials at GAR like?
Well, the revenue has been growing for the last 4 years. However, the growth rate of last year, 1.6%, was significantly lower than the average of the last 5 years, where it has actually been about 50%, excluding 2009 because of the crisis. Regarding the geographical breakdown of the revenue, 11% is generated in Indonesia's local market, 21% in China, and 68% in exports. The major contributor to the revenue are crude palm oil with 44% and unbranded refined products with 29%, while branded products contribute to 8% of the revenue.
That's interesting. What is the cost structure at GAR like?
So actually for 2012, the cost increased at a higher rate than the revenue, mainly due to labor costs, not only because of a rise in the minimum wage, but also due to new hires and promotions inside the company. The increase in minimum wage seems to be a structural change in the longer run. Therefore, the company will need to improve operating efficiency via greater innovation or application of technology. Also, the operation in China has been loss-making ever since the consolidation of an acquired company. It seems like GAR is experiencing higher margin squeeze due to the overcapacity in China when compared to bigger players with better economies of scale. So the increase in production and administrative costs, together with the loss-making of the China division, have squeezed the margins of the company. Actually, for 2012, the revenue was $6,000 million, the net profit $410 million, and the EBITDA margin 13% compared to 19% in 2010. And also, the ROE has been declined to 5% and is significantly lower than the average in the industry, which is around 15%.
That's interesting, Monica. How is the company then financing its operations?
Actually, during 2012, the company increased the liabilities by 25%, issuing convertible bonds and also through a note. This resources were used to purchase additional plantations and also to invest in a private equity fund that is focusing on palm oil plantations in Liberia and Indonesia. But this fund is highly leveraged, indirectly increasing the leverage level of the company, therefore increasing its risk. So also during 2013, the stock price has fallen 15%, underperforming the Straits Times Index. During the last month, the stock had fallen around 10% due to an announcement made by the Norwegian Sovereign Wealth Fund, which is the largest in the world, and it announced that it divested actually out of 23 Asian palm oil companies due to concerns on the unsustainability of the plantations.
Wow. So it seems like sustainability is a big issue for the industry. Let's look at how GAR has been performing with sustainability measures in its operations.
In 2010, Unilever and Nestlé decided to stop all orders from GAR due to a Greenpeace campaign. As a result, the company is more active on sustainability practices and is focused on employee fairness, multi-stakeholders management, and environment-friendly policies. The objective is to be 100% certified by RSPO in 2015.
So Monica, based on the financial analysis you just shared, it seems that there are a couple of weaknesses to GAR's operations, such as the sustainability of its China business, the high leverage, and an ROE which is below the industry average. But I think it's a good thing to talk about the strengths of GAR at this point in time. As we know, GAR has a large land bank in Indonesia as well as a strong vertical integration in the palm oil business. Also, being a leader in the production and land utilization allows GAR to produce a wide variety of products, many of which have a strong brand presence. This would further question how are the opportunities for GAR? GAR can look at promoting horizontal expansion by expanding business into Africa. Also, vertical integration by including futures trading, and diversification by entering new vegetable oil markets such as soybean and rapeseed, also including production in biodiesel.
Well, I agree with that, but there are a couple of threats in the industry. GAR is exposed to high trade tariffs and low-cost subsidies. Also, there have been an increasing amount of land regulation in Indonesia added to the rise in labor costs. Also, some of the countries such as China and India have increased their stocks of crude palm oil, and the growing consumer sentiment about the environment is an issue.
Okay, how about the competitors of GAR? It seems like there are two key aspects to this industry: vertical integration and diversification. How have GAR's competitors been performing in this space?
So we have this defined as competitors, companies that own palm plantations and that also have some degree of vertical integration. So we consider companies such as IndoAgri, KLK, Sam Darby, Felda, IOI, and Wilmar. So we have done an analysis considering the profitability level, taking the EBITDA margin as an indicator, and also the diversification from one scale from 1 to 5. So as we can see in that chart, we cannot see a clear relationship between the diversification degree and the profitability level.
Based on our analysis of GAR and the environment in which it operates in, we have derived 5 key insights. On our study of GAR's competitors, both local and international, on parameters of diversification and profit margins, we found that there is no real correlation between diversification and level of profitability. Secondly, we looked at GAR's core competency and found it to be its vertically integrated operations, where it controls the entire value chain from R&D in seeds to refining of crude oil. Third, we have, based on our industry analysis, we believe that there are considerable opportunities still in the palm oil industry. Trading, exploration of biodiesel, as well as moving into new markets are some key growth areas. Four, labor costs constitute a considerable chunk of the cost of goods sold, anywhere between 30 to 45% in case of GAR. Now, labor costs are increasing in Indonesia, and that's resulting in a downward pressure on profit margins. Finally, the palm oil industry is extremely sensitive to global trade regulations. Countries like India and China are imposing tariffs which are bound to reduce the amount of imports in these two countries. The industry is also highly sensitive to changes in consumer demand. Going ahead, we have 3 broad recommendations for GAR. Focus on growth, control costs, and focus on sustainability. GAR should look at growth both horizontally and vertically. Horizontal growth should be where they concentrate at expanding their China operations through strategic sourcing of raw materials, expansion of distribution networks, and flexible production techniques. They should also look at the investment in Liberia as a pilot project before expanding their operations in Africa. Under vertical growth strategies, we believe the two that can deliver most value are investments in biodiesel. We're very bullish on this sector in the medium term, and trading. GR is increasingly moving from a pure play plantation owner to an investment holding company. Controlling costs are becoming a very key challenge for companies like GAR. Labor accounts for a significant chunk of COGS, and we believe techniques like R&D and yield management could help reduce costs in the long run. Finally, sustainability. We believe GAR is doing a lot more than mandated by the RSPO, and that they should actively promote these activities through PR and other forms of media. We believe that through these activities, they would be able to gain a sustainable competitive advantage, especially in an environment like today, where customers are increasingly focused on sustainable activities in the farm industry.